Hey, my name is Kevin, and this is my channel Entertaining Entropy. If you're liking what you're seeing here, I would hope that you would subscribe to my channel to continue to see more stuff that I unfold and continue to add here week to week on my channel, Entertaining Entropy. Today I'm talking about Robinhood and options trading, so I have to start off by saying I am not a financial advisor and this is not financial advice. But going over the basics of options trading, I'm hoping to empower people that normally wouldn't approach this, wouldn't really have any idea, and would seem really intimidating to try to do options trading. I'll include a referral link to my Robinhood to give you guys a leg up on your trading and in the description of the video. So let's get into it. Robinhood is the app that I like to use to start with this, really because it has zero fees. Some other brokers might be better for trading options, but this is the one that I found is easiest to get in for new users. Has a lot of information, safety nets to keep you on track with your investments. And it will fall short once your account reaches a certain amount, but Robinhood is ideal for those small accounts, at least in my opinion. They even have a podcast that comes out daily in 5 or 15-minute segments, so you can check those out. Starting with what options were and how they were originally invented. Options were originally created as an insurance contract to protect your stock if you expected a sudden drop in price. It takes some of your risk off the table by allowing for example, to buy insurance for the downside. Buyers purchasing this contract have a right to execute it, which means buying or selling 100 shares at a specific price, and this is called the strike price. Executing is optional to the buyer, but it is always in 100 stocks for options. The contracts are always sold as 100 stocks at a time. The contracts are sold at a premium and last until a specific date, known as the strike date. There's 4 different types of options that you can buy and combine. Let's go through them. First, you can buy a call. Buying a call gives you the ability to buy 100 stocks at a specific price by a specific date. You pay a premium to be able to do this. For example, if I wanted to buy 100 stocks at $1 in a week, I'll pay $5 for this options contract. And if the stock is at $1.10 at the strike date, I would make a $5 profit because I bought a call. I could also buy a put. This gives me the ability to sell 100 stocks at a specific price until a specific date. I would pay a premium to be able to buy this put contract. In this example, if I wanted the ability to sell 100 stocks for $1 in 1 week, I might pay $5 for this contract. If the stock is at 90 cents on the strike date, I would make a $5 profit. You could also sell a call. This allows you to collect a premium, but you may be required to sell 100 shares of the stock at a specific price by a specific date. You could also sell a put. Here I would also collect a premium, but I may be required to buy 100 shares of the stock at a specific price by a specific date. When selling options, they automatically execute at 4 p.m. on the strike date if the stock is in the money. In the money means that the options contract has value. And when selling options, there's always collateral that is held for the length of the contract. Spreads are an idea where I can combine multiple tactics of buying and selling options and chain them together to give myself more options. And here I'm buying multiple options at the same time to create things like debit spreads, credit spreads. Other situations and strategies get cool names like iron condors, iron butterflies, straddling or strangling a position. I can get into these more in some of my other videos. So this is what buying and selling calls would look like on the Robinhood platform. Here I have at the top the buying and selling options where I can choose to buy or sell a call or a put. You can see it refreshes the screen as I go through these. As I change the date range as well, you'll see the numbers are updating here. This is times 100, so 14 cents is really $14 worth of credit or worth of cost that would get to me. So when I'm selling options, it's always a positive. You can see here, credit represents money going in my pocket. And here where I'm buying, it's a cost. Buying calls and puts is a more affordable way to tie yourself to the gains or losses of a stock in a good way. But in this way, it's still a gamble. This is why I sell options primarily instead of buying them, because when buying options, you're typically going to be just trading the premium for that contract. So now introducing my favorite strategy. It's called running the wheel, and I just got to give a full disclosure. I did not invent this. It's just the one that I like to use. The idea here is just focusing on selling options. From a high level, running the wheel consists of selling a put on a position to get into it. When or if the put I sell turns into shares, I then sell a call on my 100 shares. If I end up with that ends up selling my shares for money, I start the process all over again. Each time I sell a position, I make a premium. So let's break it down a little bit more and understand how it works. So to start the wheel, I sell a put on a position, which means I'll be forced to buy 100 shares of that position at the strike price if it's below that strike price at 4 p.m. on the strike date. The strike date is when a contract ends. I receive a premium for opening this position. For example, let's say the strike price is $1, and after the strike date has passed, the stock is 99 cents. I will buy 100 shares for $100 in total. Because of this, Robinhood will hold the $100 in this example position if I were to open it. If the stock was above the strike price by the strike date, I get my collateral back, $100 in this case, and I keep the premium for opening this position. If I end up with the 100 shares, I just flip my position. Instead of selling puts, I now invest and sell calls. On the 100 shares that I own, I can make a premium each time I do this. Robinhood, in this case, holds the 100 shares as collateral, just like it held the money when I was selling puts. By selling calls, I'm betting that the share price will stay below the strike price until a strike date. For example, let's say that the stock price is 99 cents or less. That means I can sell a call at $1 or more. And if the stock goes above $1 at 4 p.m. on my strike date, my shares get sold, all 100 shares get sold at $1, and I also keep my premium. If the stock stays below $1 at 4 p.m. on my strike date, I get to keep my shares and the premium for opening the position. If that happens, I just sell my calls again. You always keep the premium. So as you're running this wheel, getting in and out of position, in these examples at $1, I'm just collecting premium and getting back in at zero loss. There's ways to deleverage your position once you get rolled into a lot of shares or a lot of puts. Buying a put at a far dated option would secure your shares that you may hold. One of the risks of the wheel is that you're holding a lot of stocks and the prices can drop faster than your stock strike date approaches and for more than you received on your premium. So by buying a put, it ensures that you can sell 100 shares at a specific price until a specific date. You can typically get these out at about a year or two. Risk versus reward. By securing your position, you are also giving up your profits by purchasing this insurance. If I lose the shares through the process of the wheel and end up with extra contracts, it's profit lost as well, unless I get back into the shares at the same price range. I think this is a good fit for my strategy. I may do this for half my shares that I'm holding when selling calls on a position, but maybe not great for everybody. I tend to sell options a month or two out, but I deleverage and take some risk that really could sell calls much further out, a year or two, if I wanted to pull some money in and get less premium out of the short term. By sending a call out to a further dated option, I get a lot more money in my pocket, but I'm tied and lost gains if that stock tends to jump really high above the strike price. Say it's $1 and the stock by a year or two out goes up to $3. I've lost out on all those profits, but I've taken money today as opposed to 3 years later. Another way that I like to strategize is I use a stock called SPY, S-P-Y. It's an ETF on Robinhood that follows the S&P 500. And the S&P 500 is basically these top 500 stocks on the market that to me represent a safe investment, and they are always going to be getting gains year over year. So it's more of a long-term investment, but it's a good place to hold your money as opposed to just having it sit and do nothing. So these gain good interest until they add up to enough to purchase more options or take profits. So usually I'll take my premiums and dump them into SPY, and as they're gaining profits and as I'm adding to them, I'm adding more to my profit pool. Because there's no fees on Robinhood, I like to use SPY as a location to store funds that are not tied up in options, and I can always move them later. So my favorite stock to get into options with is NAK, N-A-K. I don't know how long they're going to keep going sideways, but they've been doing it for a really long time. The 50-cent calls and 50-cent puts are really around the area that I'm trading because it's been going sideways for the past couple months, right around 40 to 50 cents. And they're paying out premiums of about 20% every 2 months. So it's an incredible investment and really quick payout that you can get to for a really cheap stock. Being 50 cents, NAK is really easy to get into and really easy to scale as well. So if you only had $50, you could start to get into this option trading. And if you had $5,000, you could also get into it as well at the same percentages. Checking in regularly, stocks can move rapidly. So understanding the underlying stock and news that could surround a stock is a major advantage. If your option's underlying stock is dropping rapidly in price, you may be forced to give your premium back or pay more to get out of your position. This is typically when you're selling calls, but recognizing this early and getting out quickly can save you from a much greater loss. Something that I've noticed is that selling calls on days where the stock price is increasing, you'll have much higher premiums. You'll also want to sell puts on days that the stock price is going down, and you'll have much higher premiums on those as well. This may mean that your wheel doesn't open and close new positions at the same time, in a full cycle. You may have to wait a day or two for the good entry points. If the contracts are a month or two out, a day or two isn't really going to change a lot in terms of premium overall, but really could change a lot in the amount of the payoff. You want to watch the stock price carefully and look at the history of the stock before getting into it. What are its tendencies? A stock that is going sideways is perfect for running the wheel because you can get in and out of a position at the same level and not lose any money. I've been burned on a stock that seemed like a good deal, only to later find out that it was on a continuous downward streak and it had been going sideways for a year or more, and it's likely going to be going down continually. You don't want to get over leveraged into a single position. Apps like Webull have scanners that allow you to find new stocks that are good for options trading, so building those, you really want to spread your wealth out. If you liked this video and you found it interesting, leave me some comments and some information about how you did. Leave me some questions if you got them, and also leave me some content that you'd like to see on future videos. Thanks so much. Have a great day.